Good morning, and welcome to the Daily Hunt for Multibaggers. It's Thursday, October 30th, 2025, and we've got a lot to unpack from yesterday's market chatter.
That's right. We've seen a pretty substantial increase in social media posts across the board. The overall sentiment is a real mixed bag today, with some incredibly bullish takes, but also some serious caution being thrown around, especially when you dig into the underlying data.
It's always an interesting day when the community's got strong opinions, you know? Let's dive right in. First up, we're looking at Amazon, AMZN. The buzz is all about Project Rainier, their new 2.2 gigawatt AI data center for Anthropic. Users are calling AMZN one of the most undervalued big tech stocks, with projections that AWS growth could jump to 27% next year. Analysts are even raising price targets, some up to $300. It seems like a clear AI winner.
Well, Ethan, undervalued is a strong claim when its price to earnings ratio is 35 and price to book is over 7. That's a premium, not a bargain. While the projected AWS growth is impressive, current revenue growth sits at 13.3%. That 27 isn't realized yet. And the stock is trading almost at its 52-week high, which suggests a lot of that future optimism might already be priced in. Plus, their next earnings are today, which can be a real wild card.
Right. So for AMZN, with current price and valuation at such a high, I'd say, given the insights, it's a stay away for now.
Next, let's look at Mr. Cooper Group, COOP. The community sentiment is bullish, linked to rocket companies RKT. Goldman Sachs reportedly raised their price target to $22, and other firms are even higher. Users are expecting it to hit the 20s again after earnings, despite some recent dips.
I see why, Brooke. The historical performance is fantastic. It's moved from around $90 to over $210 in the last year. And get this, an operating margin of nearly 48%. That shows incredible efficiency and profitability in its core business. That's a strong indicator of a well-run company.
It is a strong operating margin, I agree. However, we have to talk about the debt-to-equity ratio, which is an extremely high 238. That level of leverage, it introduces significant financial risk. While the profitability is compelling, that debt load requires serious attention. Considering both the positives and that glaring debt, I'd classify COOP as a cautious buy.
Moving on to Core Scientific, CORZ. The community is incredibly bullish here, largely hoping shareholders reject the CoreWeave acquisition. They see CORZ as an undervalued gem due to its massive power assets for AI data centers, projecting huge future profits. Analysts are even upgrading it to a buy, assuming that no vote. The shareholder vote is actually today.
Ethan, that's pure speculation, While the enthusiasm is high for a specific event today, the company's current financial performance is frankly abysmal. We're talking negative revenue growth, negative net profit margin, negative EPS, negative operating margin, and even a negative price-to-book ratio. This company is currently losing a significant amount of money and has negative equity. Buying in now is placing a bet solely on a single event, not on a fundamentally sound business.
So with those numbers, it's a stay away for CORZ. Reddit, RDDT, is another one sparking a lot of debate. Many users have strong long-term conviction, believing it could hit $100 billion market cap eventually. Its revenue growth is nearly 78%, and analysts are raising price targets, expecting strong Q3 results. There's a lot of belief in the platform's future.
While that long-term vision is enticing, Ethan, the immediate picture is a bit rocky. The price-to-earnings ratio is almost 95, which suggests a huge amount of future growth is already baked into the current price. There's also significant user concern about near-term volatility, especially around today's earnings report, and a very real political risk where a single event could send the stock plummeting back to 100. That's a considerable downside from current levels.
So RDDT continues to be a stay away based on those risks. Alphabet, Google, is looking really strong. Users are celebrating significant gains and predicting it'll hit 300 before the end of the year. They just beat Q3 earnings, showing excellent revenue growth and a robust net profit margin. It's clearly seen as an AI winner, and increasing capital expenditure signals ongoing investment in future growth. It's practically knocking on the door of its 52-week high.
I concur, Ethan. The numbers for Google are compelling. The positive momentum, coupled with strong revenue growth of nearly 14% and a net profit margin of over 31%, paints a very healthy picture. Their efficient use of shareholder capital is also excellent. While the PE is relatively high, for a growth giant like Alphabet, it's not a red flag given its consistent performance and clear position in the AI race.
So Alphabet, Google, is a solid buy in our book today.
Next, we have Plug Power, PLU. There was some talk about insane short interest, but that argument is already being challenged by other users. More importantly, when you look at the financials, it's a very concerning situation.
Yeah, they're in the renewable fuel space, which is a big growth area. It's a volatile stock with a high beta, so if it catches momentum, the upside could be quick.
Potentially, Ethan, but the fundamentals scream caution. Negative net profit margin, negative EPS, negative operating margin. This company is reporting significant losses across the board. Add to that a debt-to-equity ratio of over 56. That's a lot of leverage, and it's a big financial risk when you're not profitable. The current price is also significantly below its 52-week high, reflecting those underlying issues.
So, despite the industry's potential, for PLU, it's a definite stay away. Rocket Companies, RKT, is generating bullish sentiment. Goldman Sachs has raised its price target to $22, with others pushing for $25. Users see it as a long-term play in the interest rate and housing market, expecting it to rebound into the 20s after its Q3 earnings, which are due today. Revenue growth is positive, showing some signs of life.
Positive revenue growth is good, Ethan, but the core issue here is profitability. The EPS is negative and the net profit margin is essentially zero. This means the company is not consistently making money. And the debt-to-equity ratio is an astronomical 273. That's an extreme amount of financial leverage, which creates immense risk, especially in a sensitive market like housing and interest rates.
Therefore, for RKT, it's a stay away. Lastly, Oculus Holding, OCS. The community chatter is a bit mixed, with the posts actually focusing on optical circuit switching technology rather than OCS, the company. But we do see news about OCS making positive strides in ESG, which is good for its public image. And its current price is almost at its 52-week high, showing recent upward movement.
The ESG news is a positive, Ethan, but the financial KPIs for OCS are deeply concerning. Negative earnings per share, a net profit margin of 0, and a massively negative operating margin of nearly 80%. These numbers indicate severe unprofitability and a struggle to generate any value for their shareholders. While the debt to equity is manageable, the consistent unprofitability makes it a very risky bet.
So OCS is a definite stay away for us today. And for Palantir, PLTR, we've seen a lot of users celebrating huge gains, with the stock nearing $200. They're touting strong revenue growth, solid profit margins, and big new deals like the Lumen partnership. Jim Cramer is even calling it a leader in the year of magical investing. The community is very excited.
The community's excitement about past gains is clear, Ethan, but the valuation for PLTR is something else. We're looking at a price-to-earnings ratio of over 662 and a price-to-book of nearly 80. These are extremely high multiples, suggesting the stock is significantly overvalued based on current earnings and assets. It's also trading almost at its 52-week high, and with a beta of 2.59, it's incredibly volatile. Many users are actually advising profit-taking ahead of its upcoming earnings, fearing a drop. This looks like a very risky entry point right now.
So for PLTR, it's a stay away from us. All right, let's wrap up our hunt for today. Here's our compiled list of candidates for deeper analysis. Investigate as buy, Alphabet Inc., GOOG. Investigate as cautious buy, Mr. Cooper Group Inc., COOP. Investigate as speculative gamble, Core Scientific LLC, CORZ.
And that brings us to the end of today's Daily Hunt. Before we sign off, a quick reminder.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for tuning in, everyone.
We'll catch you next time on the Daily Hunt for Multi-Baggers.